For 2 years, one force has quietly capped Australian inflation at the margin, Chinese exporters absorbing rising domestic costs rather than passing them on to Australian importers. That constraint may have ended on Friday in Geneva, and most of the local market hasn't priced the shift yet. The ASX 200 closed the week on a 5-day high, miners leading the rebound, the index up on the session. On the surface, the session looked like a straightforward risk-on day. Copper producers lifted, gold explorers found fresh broker interest, and Arafura Rare Earths launched a $350 million institutional placement after the federal government took a cornerstone position in its Nolans project. The day's loudest story was Guzman Y Gomez closing its U.S. restaurants, watching its market capitalization rise $260 million on the news. Capital rewarded retreat. That's the session's visible narrative. But the piece that matters most for Australian portfolios in the next 6 months didn't get a headline number attached to it. Business columnist Robert Gottliebson, writing in The Australian, reported that in the weeks before the US-China presidential summit, Chinese and China-linked exporters had already begun warning Australian importers that price increases were coming. Some buyers dismissed the warnings because China still needed to replace US market access. The diversion logic had held since 2023. That logic is now in doubt. NAB on Friday shifted its final rate hike call from June to August after April unemployment printed at 4.5%, the highest since the pandemic, with 18,600 jobs lost in the month. Westpac described the data as genuinely weaker than expected. On the surface, that looks like a dovish repricing. A weaker labor market, a later tightening cycle. But NAB senior economist Taylor Nugent used a specific phrase that sits at the center of this. The balance of risks has shifted. Shifted toward what exactly is the question the unemployment data alone cannot answer.
The mechanism is direct enough that it's been taken for granted. China's exports to Australia, household appliances, mobile phones, laptops, solar panels, electric batteries, have held price essentially flat, even as Chinese import costs rose. That price discipline was a function of China's need to expand non-American markets after U.S. tariffs severed its largest export channel. Every month, Chinese goods arrived cheap, Australian retailers absorbed less cost pressure, and the headline CPI stayed lower than the underlying domestic cost structure would have produced on its own. Westpac and ANZ's June pause call is built on that import price assumption holding. Strip it out, and the rate path does not look the same. Here is where the US-China deal changes the pressure position, not just the narrative. If China secures regularized access to the U.S. market, not penalty tariffs, but standard tariffs, the incentive to subsidize non-American buyers by holding prices down weakens materially. China no longer needs to push volume into Australia at cost. The exporters who warned Australian importers in April were not speculating. They were describing a pricing environment they could already see forming. Trump's delegation in Geneva included Jensen Huang of NVIDIA, Tim Cook of Apple, and Elon Musk of Tesla. The presence of the U.S. technology industry's 3 largest executives signals that the deal framework extended well beyond headline tariff rates. Heavy rare earths were reportedly a central agenda item. The Iran war has drawn down U.S. strategic reserves, and China controls over 60% of global rare earth processing. Australia's own Nolans project, now funded and construction targeted for September 2026, is described by the federal government as the only near-term solution to supply chain vulnerability. But Nolans is not producing oxide in 2026. The U.S.-China rare earth arrangement, if it closes, buys time for the Americans and creates the conditions under which China extracts pricing power elsewhere. The countersignal. Westpac economist Ryan Wells attributed part of April's unemployment weakness to abnormal Easter seasonality, and ANZ still expects the RBA to characterize the labor market as tight in the June statement. If that framing holds, the RBA's stated tolerance for monitoring incoming data holds with it, and the rate path stays deferred. That is the current market consensus, but the consensus is priced against Chinese export behavior that a bilateral deal now puts in question.
That unresolved question from the paradox layer is the one NAB's revised timeline cannot answer with labor market data alone. When will Chinese export prices actually move, and by how much? The historical reference point is not recent. In the early 1930s, Australia's import cost structure shifted sharply when the tariff environment that had kept manufactured goods prices suppressed changed across multiple trading partners simultaneously. The RBA's predecessor institution found itself responding to imported inflation it had not anticipated, in an environment where domestic labor data had been giving a different signal. The mechanism is different. China's share of Australian imports is far more concentrated than any single trading partner in 1930, but the sequencing is comparable. A trade arrangement changes, import prices follow, domestic inflation surprises the central bank, and the rate path that was priced as terminal proves not to be. Westpac is currently forecasting 2 further rate hikes in August and September, taking the cash rate to 4.85%. That call was made before the Geneva summit. It is the only major bank forecast that explicitly leaves room for rates moving higher on inflation grounds, and it is the call that now looks most exposed to being right for the wrong reason, not because domestic labor is strong, but because import prices move. The verification benchmark is not a rate decision. It is the next monthly CPI print for the household goods and electronics components, specifically the categories most directly exposed to Chinese export pricing. If those components begin moving in the June or July print, the RBA's June pause becomes a narrower pause than the market is treating it. The leaning is toward the rate path being extended beyond August, conditional on Chinese export prices beginning to move. The recovery case exists. If the US-China deal stalls on rare earth terms, or if Xi Jinping's planned September visit to Washington produces no binding agreement, China's incentive to hold Australian prices down returns. But the gap between those two scenarios, deal holds versus deal stalls, is not an event the local equity market has priced. The question the data cannot yet settle is whether Australian importers who received those April price warnings have already begun adjusting their purchasing terms, or whether the repricing has not yet reached invoices. That inventory level signal will be visible in the next quarter's retail cost data before it reaches the CPI. The question is whether the RBA will be watching the same price. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.